Welcome once again to Tag Investments. My name is Anuj Gupta, your strategic wealth consultant. Today's topic is market Kya Lagta Hai. So a lot of investors are asking us, is it a good time to enter the markets? Is it the right time to book profits and exit the market? So we've seen the March lows in 2020 and we've seen the highs in August, September 2020. We've almost recovered all the losses which we suffered in the month of March 2020, and as we speak in the month of September 2020, we've recovered almost all the losses. And somebody who had recently entered in the month of April, May, June 2020, they would have made a handsome 20 to 50% returns in a short period of 3 to 5 months. So we're going to talk about pain or pleasure, entry or exiting the market in present scenarios. So in case you haven't subscribed our channel, please do subscribe our channel for getting updates and informational videos such as this one. So pain or pleasure, asset allocation is a must. Market, whether to enter or to exit. Well, just a disclaimer before we start our presentation that this presentation is for informational purposes only and we do not intend to give any advice on this topic. Return of capital is more important than return of capital. We'll speak on this as we move ahead. But just to give you a sense that ultimately for wealth creation, wealth preservation is very, very important. So you should not lose out on capital at any given point of time. In greed of money or in greed of making good returns, you should not take risk on your capital. That is what we say by return of capital is more important than return of capital. Now, to understand this further, we should understand what are the brain objectives and how does the brain function. So we're going to talk about finance here and about what's the main topic of discussion for today, which is whether you should enter or exit the markets. We will cover that as towards the end of the presentation, but please hold on and listen to and understand how does the brain objectives work, or what does the brain think. So brain thinks about a feel-good factor. It wants security. It wants to feel secure. It thinks of survival. It thinks of getting rewards, and it also wants to avoid pain. So this is generally how the brain works out. The objective of the brain is divided into these 5 factors. Now there is an emotional side of our brain and there is a functional side of our brain. Now we've tried to address it by just giving you an example. If we are going shopping and buying a dress, a watch, having some you can say food, or going for a movie, we take emotional decisions on it. We don't really see the price of the dress. We don't see the like when I say we don't see the price of the dress, we do see the price, but we take emotional call that it's good looking. We are ready to pay the price. We really don't get into too much of technicalities on it. Similarly, there is a functional side of the brain, meaning to say when we are going shopping for a car, bike, or setting up a power plant, then the functional side of our brain gets active, where we want to see the technicalities, what is the average, what is the horsepower, what is the engine capacity, what's going to be, is it really going to be the worth spending that much money. So that's the functional part of our brain. Now, coming to the market side of things, so understanding, once we've understood how the brain works, now timing the market and not staying in the market, not spending time in the market can be really, really dangerous. Now, how we are trying to show this to you is, this is a 30-year analysis which we have done for Nifty. The source is MOAMC, that's Motilal Oswal AMC has given us this chart, courtesy Motilal Oswal. So what we have done is we've tried to show you the last 30 years analysis of Nifty, which is a total of 10,900 days. So somebody who stayed invested for 10,900 would have made a 31x returns. But in a bear market, somebody who missed 10 days, best 10 days, he would have just made 11 times the returns. So a huge difference from 31 times to 11 times. Somebody who missed 20 best days in a bear market, that particular investor would have made 6x times in the last 30 years. And somebody who missed the best 30 days out of the 10,900 days in the bear market would have just made 3x times the return. So what we are trying to show or make you observe in this slide is that the best 30 days in the last 30 years are in the bear market. Now, you would have witnessed it in the recent 6 months. So, from March lows to August, September 2020 highs, the best returns you would have made in the last 3 years, 5 years would have been in the last 6 months, where the world is thinking that we have entered into a bear market or everything is going to get destroyed, everything is in a lockdown stage, and nobody is going to make profits. Actually, investors have made the best of profits in the last 5 6 months as compared to the last, say, 5 years for that matter. Now, we are coming closer to that topic of whether we should exit the market at this point of time or not. So, just to give you an idea, Nifty P ratio is one of the parameters via which we judge whether we are into a overvalued market or an undervalued market. So Nifty is at 32 and Nifty 500 it's at 36.62. Now, what is working? What is going on with the economy, and the markets are doing well. So when we did a survey within our investor community and within our colleague circle, so we saw that the lockdown is still continuing, although we're talking about unlock 4, unlock 5 as we speak today. Then there's a new margin system. Not many of the viewers listening to us will be aware of this, but then all those who are into the trading zone will be aware that there is a new margin system introduced. At the same time, we are surrounded by negativities which says no travel, no rail, labor issues are there, GDP growth negative, which was just recently announced. Unexpected rise in market is giving a jitters to the investor fraternity. Job losses are there. Vaccine, there is no clarity for corona vaccine, if it's going to be out or not. Hospital spaces are filling up fast. Work from home culture is still prevalent. Schools are not opening up. So these are the negativities in the economy, and when we talk about that, what's going on with the economy as such. Now, at the same time, whenever we see that the markets are inflated or overvalued, generally, if you go by the past history, we see that there were a lot of NFOs, IPOs, TV shows, fund flows into the mutual funds, and nobody was really aware what the market is, what's happening in the market. But this time it's different. There isn't many NFOs which have come up. There are not IPOs which have come up in the last 6 months. There are no TV channels, shows, radio airing going on that mutual fund sahi hai, and there is not a lot of people investing in mutual funds. There is no fund flow in mutual funds. Everybody is already aware about what's going on in the market. They are already fearful in terms of the markets are at their all-time high. So all these are characteristics which are generally missing when the markets dip or take a toll. Now, this chart will give you a further clarity as to what's happening. Now, this on the right-hand side, we are talking about the domestic inflows, and this is on the foreign inflows. So in the last 3 months, if you see May, June, July, August, there have been a massive inflow in the foreign institutional investors. Similarly, for the domestic side of things, you see that in the month of May, June, we saw positive returns, positive inflows, but in the month of July and August, we've seen that actually the domestic institutional investors and domestic players are exiting the market. So what we're trying to show by this chart is that there isn't a lot of inflows from the domestic players as such. So again, is it the right time to enter or right time to exit? Keep watching. My request to you is, in case you have not subscribed the channel, so please do subscribe our channel so that you can keep getting this informational videos on a regular basis, and you can take you can stay updated as to what's going on in the markets and the economy. Now, this is already out as we speak. Now we are in the month of September, but Google already released this data that the forecast is that we'll be negative GDP, which the data is already released for Q1. Now, mutual fund inflows in July in India. Now, according to the data released by AMFI, Association of Mutual Funds in India, on Monday, there was a net outflow of 2,480 crores in July, the first sell-off since March 2016. In June, net inflows were at 240 crores, the lowest in 51 months. In July last year, these funds had received 8,000 crores worth of net inflows. Now, what I'm trying to put across by showing you this information is that we are not seeing inflows. Despite that, there is a surge in the market or there is a surge in valuations. So again, this confuses the investor fraternity actually whether we should be exiting the market or entering the markets at this given point of time. Watch more data so that you can take a, you can say, a decision basis on information basis on data. So here we are trying to show you as much information and data so that you can take a good decision whether you should be entering the market at this given point of time or you should be exiting the market. Now, the DIIs flows, so they have actually started booking their profits in the last July and August, if you can say so. When I say booking their profits, means they have started exiting the markets, domestic players. The mutual funds have actually seen a dip in terms of their revenue, in terms of their inflows. So this is the chart which shows that from these particular schemes, sectors or themes, there have been an outflow. Similarly, SIPs, if you see from March till June, July, we've seen a drop in the SIP numbers, which means people are stopping their SIPs. Now, again, please don't treat this as a negative news. What I'm trying to put across again and again by showing you these numbers are that there isn't a overburst or a bubble which is being created. Generally, there is a sudden drop or there is a crash in the markets when there is a lot of inflows which are not happening in the markets. Now, a classic example how you can understand by the virtue of seeing this gold slide is that from 2013-14 right till 2018-19, when there were outflows happening, see the numbers. The gold prices were at 29,600, 28,000, 26,000, 29,000, 31,000, 35,000. So there was outflow. So whenever there is outflow, refer to the previous slide again. So we are seeing outflows from quite some time now. Now, whenever there is outflow, it is followed by sudden surge or sudden increase in terms of their prices. So the gold, when there was outflow, when actually people were supposed to invest, people started redeeming from gold, and you see what happens in 2019-20 and 2020-21 as we speak. The gold rates have reached 55,000 rupees per 10 gram. Now, the big question is whether if you have fresh money, should you be entering the market, or if you are already invested in the markets, should you be continuing with this journey? Now, some more data on India in terms of the national level, economic level, global level, development level. So at national level, we've been dealing with corruption, Jammu and Kashmir, solving our Ayodhya problem, terrorism quite well. On the economic side, we've literally not won the war on black money, but yes, we've solved a lot of problems on black money. Forex reserves, forex reserves are at their all-time high. The markets have predominantly done well in the last 5-6 months. Yes, there is a problem at the manufacturing end and the jobs end, but I'm sure that will be sorted soon. But that remains a question mark when. At the global level, we are going good with the external affairs. There is good pride and power, which we speak with our foreign counterparts, and there is a lot of you can say respect India has garnered over the previous months and years as a country. On the development side, we are not left behind, whether it comes to space, railways, healthcare, defense. So I've spoken about during the lockdown in my previous videos that how railways during the shutdown or lockdowns phase, how they actually repaired all the tracks, how they manufactured new tracks. So you can watch those videos. In case you've not subscribed the channel, you may subscribe the channel again. So that when I say subscribing the channel is so that you can actually keep receiving these updates from our side, and you can also get access to our videos easily, which we've already made. So now some more positive factors, that monsoon is at their all-time high. Last year we saw a good monsoon. This year again we see a good monsoon. So 2 consecutive years, generally monsoons don't shower their blessings on us. But this year again monsoon have been good, and on the agricultural side of things, Uh, India is one country which has a good percentage of contribution towards agriculture, has a good contribution towards the GDP. India is one of the countries. The other being service and manufacturing departments, which are suffering due to the lockdown, but I'm sure they'll recover. The interest rates are at their all-time low. The demand is picking up because of the interest rate being low. It's encouraging for business people to take loans, but that is yet to catch up. Manufacturing and employment are two factors which we spoke that it's yet to catch up. But once this starts, then there is no looking back for India. Now, the market. Just see what's happening. Just make an observation as to what's happening in the last 5-6 months. The telecom, you saw Reliance Jio going from 800 900 levels to almost 2000 2100 level as we speak today. So almost 120% increase thanks to the partnership of Facebook with Jio and Reliance platform. We saw the FMCG industry growing in the last 5-6 months. The agri products, I'm not naming the stocks, but we've seen stocks uh, rising up to 50, 100, 200 percentage in the last 5-6 months. The pharma, it's a no-brainer that those stocks have done well. Metals have done well. The IT stocks have been performing well. The chemical stocks have performed well. Entertainment, you see stocks like PVR, despite the lockdown, the PVR stock has risen. Infra, be it L&T or be it any real estate stocks, there was a latest news that there are some tax lowering in Mumbai, and that is why we saw a sudden surge in the reality sector as well. So, auto sectors have started picking up. The numbers look good now. The reality, as I just mentioned, I clubbed it with infra. The bank just had a recent rally. Now, by this slide, what we are trying to show you is that it's not a it's not one particular industry which has shown the run up. There are a lot of sectors, a lot of industries, a lot of stocks. It's a broad based rally which we saw in the last 5-6 months, which is a positive for the markets. Now, how markets fared in the last, say, 3 years from 2017, 2018, 2019, and as we speak in 2020. The Sensex was at 34,000 level in 2017. In 2018, it rose to 36,000, and in 2019, it touched 41,000, and the all-time high was 42,274. Now, as we speak, it's hovering around 39,000 level. So we are not yet reached the all-time high, and from 2019 level, we are still at 39,000. Similarly, look at the BSE 200, top 200 companies. The level was at 4,600, then in 2018 4,600, then in 2019 5,000. The all-time high was 5,200. As we speak today, it is 4,900. The BSE 500 from 15,000 it dipped to 14,000, then to 15,000. The all-time high was 16,000. As we speak today, it is at 15,000 levels. But interestingly, see the mid cap and the small cap. In 2017, it was 17,000. Then in 18, because there was no broad-based rally in 2018-19, so it actually went down to 15,000 level, then to 14,000 level. All-time high was 18,000, and we are still at 15,000 as we speak today. In small cap, the all-time high was 20,000, and we are at 15,000. So in no ways is the broader markets are at the all-time high, and there is no fear of a bubble which is created. Generally, whenever we see a huge correction, it's due to bubble. It's due to a bubble in the broader markets, or due to overinflation or overvaluation in the broader markets, which we do not see. This slide proves this point. Now, more interestingly, the market cap. Now, the market cap, please understand, in 2018, Jan 2018, it was at 160 lakh crores. In Jan 2020, it was at 160 lakh crores. In March 2020, it bottomed to 102 lakh crores. And as we speak today, it is again at 160 lakh crores. So what I'm trying to put across by showing you this slide is the market cap from last 2.5 years is still the same. So again, there is no overvaluation in the markets. What is happening? What happened in the last 2 years was that there was a you can say stock specific rally. A handful of 6-10 stocks were actually leading the markets in the last 2.5 years, and that made the Nifty levels, Sensex levels look high. But otherwise, from the last 2.5 years, if you see, the market cap is almost stagnant. It dipped down to 102 lakhs crores in 23rd March 2020, but as we speak today, it is again 160 lakh crores. So we've not seen an overvaluation happening in the last 2.5 years. Now, Sensex versus market cap. In 1995, we were at 3 lakh crores. In 2005, we were at 30 lakh crores. In 2015, we were at 100 lakh crores. In 2018, we are at 150 lakh crores. In 2025, will we reach 300 lakh crores level? Now, what we are trying to show you is that it's a no-brainer that market cap has to rise with time. Nobody could imagine that in 1995 we were at 3 lakh crores and today as we speak we are at 160 lakh crores. Or in 2005 we were at 30 lakh crores, or in 2015 we were at 100 lakh crores. Nobody could imagine that it's going to reach at 160 lakh crores. And today when we are at 160 lakh crores, it is very much possible for us to reach at 300 lakh crores by 2025. Will we or will we not? That's a question, or that's something which we need to ponder about. But what I'm trying to put across to you guys is that 300 lakh crores is possible and we will reach that level. Now, one of the famous parameters whether to judge whether the markets are undervalued or overvalued is it's called a Warren Buffett factor, or a Warren Buffett way of judging the markets whether it is overvalued or undervalued. It is called GDP to market cap, or market cap to GDP. In case if the market cap to GDP is hovering between 75 to 80, it is average. It is we can call the markets are fairly valued. If it is below 75, then we call it is undervalued. If it is more than 80, 85, then we can say, or rather if it crosses 100, then we can say it is overvalued. So just to give you an idea, India's market cap to GDP is approximately 70. As we speak today, it would have reached 75-76%. When this slide was taken, we were sitting on 8th of August. That time it was at 69%. The US market cap to GDP is 169%. So that is a danger point, or that is something which we really need to think when we are investing in international funds. Now, last 10 years have been really very good, very good for international funds. But the next 10 year belongs to which zone, which country, which sector is something which time will tell. But our bet is definitely on India, because India in the last 10 years has not done very well in terms of whether it's the market returns or whether it's economic, you can say, economic corporate earnings point of view. It has not done well, but we are very, very positive that in the next 10 years, which is 2020 to 2030, we see India as one of the leading countries in terms of growth and in terms of actually creating wealth for the investors who invest in India. Now, what has been the trend in India from a market cap to GDP point of view? So the average is 76% basically. So sometimes in FY09 it touched 59, then it soared up to 95, then it dipped to 64, then again to 85, but the average is 75. And as we speak today, we are actually sitting on an average market cap to GDP. So there is no way that we are overvalued from a market cap to GDP ratio standpoint of view. Now, just to have a look at the P, Nifty P in Jan 2020, it was at 28 level. In March, it dipped to 17 levels, and as we speak today, it is at 32 level. The Nifty P, it was at 37 level, it dipped to 18. It is yet to reach its all-time high. It is at 25 level. The Sensex P from 25.8, it dipped to 15 in the month of March 2020, and as we speak today, it is at 26. So yes, the P looks costly to us, but is P the only ratio which you should look at while entering or exiting the market? The answer is definitely no. Now, some more trends. Look at this small cap valuations. From last 3 years, we've seen that the small caps have given negative returns. So this is the first time in the history that last 3 consecutive years small cap have given returns. Otherwise, the history shows that whenever a negative returns in small cap occurs, it is followed by a good upside in the small cap. So what we are trying to put across is that a rally in the small cap is yet to come. At least from the last 3 years, we've not seen a rally. And just see this small caps have always delivered massive returns for extreme point. Now, what does the extreme point means? When we saw that whenever it hovers between 0.47, that's the small cap 100 divided by Nifty 50 ratio, whenever it is 0.47, 0.5, we see a rally in small cap. Now, as we speak today, we are, this is still June data, so we are at 0.48. And if you see actually from June, the small caps and the mid caps have actually given almost a 20, 30, 40, 50% returns, the small cap and the mid caps. So we are yet to see a good rally in the small cap space. This shows the top 25 market cap companies. So in the last 10 years, what we are seeing that whichever were the best 10 companies in the next 10 years, those actually change. Barring we've seen Reliance as a common factor, but what we are trying to show you is that the the 10 companies here, if you see after 10 years, it changes, which means there is a massive growth which one can expect in the times to come. In the next 10 years, whatever you invest in, maybe a mid cap becomes the best 10 after 10 years. So one should always understand that it's a cyclical movement, and not all large caps will remain large caps in the next 10 years or will give positive returns in the next 10 years. Suraksha plus Samriddhi. Now, what we are targeting is wealth protection with wealth creation. So to sum up as to what you should be doing, whether you should be entering the markets or you should be exiting the markets. So basically, to decide what one should be doing at this point of time, whether you should be exiting the market or whether you should be staying put in the market, it all depends on the type of financial plan which you have decided for yourself. So if your financial plan tells you that you have to be secure, then definitely exit the market now. When I say secure, means you're only looking for security and there is immediate need of money in the next 6 months, 12 months, then this is the time to exit the market. If you want to live a comfortable lifestyle and the financial plan says, okay, I'm investing in the markets to be comfortable, then one can say exit partially, say a 50-50 plan works out best. So book your profits or minimize the risk by partially exiting the market at this point of time. And in case if your financial plan is to be rich, then this is the time to stay invested, because as we showed in our previous slides, the best money is made in the bear markets. So given if you are of the thought process that tomorrow there can be a correction and a huge correction and there's going to be a bear market phase, then believe yourself and believe us in that statement that when we say that the best money is made in the bear market. So given that you don't have immediate need and you are here to be rich, then this is the time to stay invested and pump more money. Also consider these 8 steps for your portfolio. Always concentrate on economy, industry and company, which means that look at what is economy doing, which industry to invest in and which particular company to invest in, because that is very, very important. Always have a strategic asset allocation versus a tactical asset allocation. While one has to look at the short-term needs, also look at the long-term needs and then take a strategic and tactical asset allocation. Investing and trading, don't mix your investment money with the trading money. So always draw a big line between investing and trading. Choose large cap, small cap and mid cap judiciously. So we recommend 50% in when we say we recommend means a good match or a good ratio would be 50% in large cap, 20% in small cap and 30% in mid cap. Value investing versus growth investing versus contra investing. So if you are a value investor who only wishes to invest looking at the valuations, if you are a growth investor that despite Reliance showing a 120% rise in the last 5-6 months and you still want to invest in Reliance, so that's something which you can term as growth investing. Contra investing is like investing in airlines, investing in entertainment sector which are in complete lockdown or in partial lockdown state. So those are the sectors or those are the companies which you can invest in. 33 is to 33% rule. So always remember while you are trading or while you are investing in stocks, if you are investing in 10 stocks, always remember 3 stocks will give you good wealth creation opportunities. 3 stocks will be wealth disruptors, and 3 stocks will always give you say 0 to 5% returns. So keep this rule into consideration while you are investing or trading in stocks. Mutual funds versus equity. So we recommend like a 80% in mutual funds and 20% in stocks. When we say recommend, means that's a good ratio to stay invested in, stay and diversify your portfolio. Good debt versus bad debt. So always remember, do not take leverage positions. That do not take money from the market on loan and then invest in the markets. That's not good. So always remember good debt versus bad debt fundamentals. We've spoken about all these in our previous videos as well. So in case if you have missed out on those videos, please subscribe our channel so that you can keep getting informational videos such as this one, and we promise to add value to your financial lives. Thank you so much for the watch. Just to wrap up the presentation, just giving you some numbers on the mutual funds side of things, that what has been the returns from 2018 till 2020 levels of various categories. So you can take a snapshot of this in case if you just want to see. So what we're trying to show is that even in mutual funds, people have made good returns or good comeback from their lows in March 2020, and it's a diversified way of investing. So somebody who does not have the patience, knowledge, interest, time to directly manage their portfolio or to directly invest in stocks, one can invest through the mutual fund route. So going further on categories, these categories have given such and such returns. Now the big question, the high Nifty, low interest. If we move out of Nifty or move out of the markets, where do we enter? FD is giving a low interest. So what is best for me? Now this is where the big question lies, and probably in a video which is one-way communication, it is very difficult to answer these questions and what suits the best to the viewer. So what we generally recommend is that in the description box or whenever you see this video, through whichever platform you're watching this video, generally in the comment box, description box, we leave a Calendly link in which basically we set up a 15 minutes discussion with our wealth experts, including me. You can catch up with me as well for a 15 minutes chat discussion as to what should be done in this scenario when the Nifty is high and we want to exit or we don't want to enter into such markets, but at the same time in the fixed income category we're talking about low interest rates. So what to do in this scenario? Real estate is not an option for most of the investors because it involves a lot of money in bulk, and liquidity constraints are always there in real estate. Not against real estate, but real estate requires a lot of bulk money, and we're not talking about that at this given point of time. So volatility is here to stay. So please understand volatility achhi hai. Given that you've assessed your risk profile, you understand what type of risk profile person you are, whether you are aggressive, moderate, conservative. So there is a scientific way of assessing your risk profile. So again, we made a video on that earlier. In case you've not subscribed our channel, please do subscribe our channel so that you get to understand these terminologies much better, and whenever we are coming up with future videos, you know, okay fine, what does risk profile means, what does risk appetite mean, what does volatility means. So it's a complete chain. So if you actually follow the video series which we are releasing, you will actually become a good knowledgeable person to manage your finances and understand how does finance work. So the past talked about the US-China trade, the future, what future has in on plate, we really don't know. The current is all about COVID-19. So please understand, in volatility market is the time when actually investors make a lot of money. So volatility achhi hai. Now scheme wise composition of assets. Now just to give you some idea where the money is going of the investors. So this is where the money is going. Almost 28% or 30 odd percent is in debt schemes, 40 odd percent is in equity based schemes, 20 to 25% is in liquid schemes, and 6 to 7% is in ETFs, exchange traded funds. So exchange traded fund is one thing which is yet to catch up, but this is a beautiful product, and I'm sure in the future a lot of ETF investing is going to go on. So please keep a watch on this and start investing in ETFs as well. Now, some of the you can again take a snapshot of this in terms of what are the returns from last 10 years of various categories in mutual funds. Thank you so much for the watch. I'm sure I was able to add some value to your financial lives and investing lives, giving you some clarity as to whether you should be entering the market or exiting the market. But I'm sure one remains perplexed as to what should be done, and that is where we come into picture to help you, handhold you, give you that customized solution which you are wanting in your financial journey. So please get onto a 15 minutes discussion with us by clicking on the Calendly link given in the description comment box through whichever channel you are watching this video. I'm sure our team would have given a Calendly link. Otherwise, you can reach out to us through any of the social media channels which we are present on. You can log on to our website www.taginvestments.in and book your appointment with us. We promise to revert to you within 24 hours whenever you book an appointment with us, and we promise to revert to you and give you a customized solution. Thank you so much for the watch. It's always a pleasure adding value, giving these informational data to you so that you can become more informed as an investor. Thank you so much. Have a good day, have a good year, and wish you all the best in your financial journey. We wish you financial freedom in the times to come. Thank you so much.